Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Allpeter, and every week I sit down with people shaping the world of acquisitions, founders who've cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Today, I'm joined by Neil Twa. Neil is the founder and the CEO of Voltage Holdings, and he helps entrepreneurs build, scale, and exit successful e-commerce brands, particularly on Amazon. So we're going to go really deep into Amazon this episode. He's also the host of a really great podcast you should listen to called High Voltage Business Builders Podcast, and he's interviewed hundreds of founders and investors about what it takes to create real transferable value. Over the past 17 years, Neil's built, advised, and exited multiple Amazon FBA businesses himself, while also mentoring others through his accelerated programs. Neil really has built his career at the intersection of Amazon's infrastructure and entrepreneurial ambition, and today we're going to dive deep into what it takes to build a business worth buying on the world dominated by one channel, which is Amazon. So Neil, thank you so much for being on this podcast. I know how busy you are with your own podcast and all the other things you're going on. I really appreciate you being here.
Yeah, it's my honor to be here. Thanks for having me on here.
So let's just dig right in. As I look at your bio and as I've listened to some of your episodes, you've really been at this for more than a decade. Help me understand how Amazon has changed from your perspective.
Two things really that come to mind to answer that question. There's Amazon itself, the platform that of course has evolved, but e-commerce has evolved itself as kind of a holistic channel now through Shopify, TikTok, other channels, Etsy, Walmart, Target Plus, Walmart Plus. So there's really a holistic strategy now to take Amazon into an omni-channel business, which I consider to be kind of a true business model, not a single channel business model. With that, a holistic appearance of the e-com company is kind of where we're at, while I incubate on Amazon brands that I determine that could fit 49% of the e-commerce market, which is Amazon. I'm looking at their buyer demographic. I'm looking at their psychology of buyer at the 200 million Prime members, and I'm going, okay, they're only there to buy in 30 seconds or less, which is very different than a lot of the other platforms. And with that kind of capacity, it gives me really a scope for what is possible in that brand. Now, what has changed is the complexity and the opportunity cost, what we would refer to as barrier of entry, has sort of changed based on the complexity of that moving model all the way up into the last few weeks, when agentic commerce protocols are coming online through OpenAI and others that are really starting to create an economic SEO engine that is very different than anybody has experienced since the first interwebs, right? Which I know I was there. And so with this change, this whole new commerce and social commerce adaptation of asking queries and asking Perplexity and ChatGPT and stuff, what's the best product type for X, or how do I use Y, or I'm going on a trip, where's the best place to go, is now an economic engine like anything we've never seen before. And Amazon's biggest update was 3 years ago as they moved towards that same agentic commerce protocol. They launched an update to their system, a major update called Cosmo, which is a AI-driven ranking analytic engine, large language model. That's a lot of things to basically say. It's a fancy, really super learning AI-driven machine. And they have Rufus on top, which is kind of your personal shopping agent to help train that model more and more on what people are buying, their customer intent, and really what customer need is. And with that, we have really changed from, and it's going to sound really weird for a lot of people, a direct-to-consumer model to a direct-to-machine model, or a direct-to-AI model. So now I am brokering data to an AI engine, and the AI engine is now the marketing machine that sells products to the customers.
Why do you incubate brands on Amazon? Why there, and why not just Shopify and Meta?
Qualifying your offer, whether it is a service or a physical product. We're in the physical product private label world. We don't retail or arbitrage. We manufacture. We trademark. We create IP. So with that, we have to really understand the market ahead of us and really know what they want. And it's one of the best places lately for us to be able to get more data that tells me a lot more about the buyer type, the psychology, what they're buying, and the need and intent of that product. And so given the fact that they're buying every 30 seconds, 6,000 times a minute, their entire mindset and psychology is to purchase something. So on a website, you have to drive traffic and get eyeballs on your offer. On TikTok, you got to do the same thing. And there is organic in TikTok, but not to the level that it is on a platform like Amazon, because it is the number one search place for product research. SEO platforms and stuff, Google and information sites don't do that, and disruptive places like Facebook or even Google Ads to some degree are disrupting people in their normal flow and trying to turn them into buyers. So with access to their customer base of 200 million people who can get products in 2 hours or 2 days or less, we now have an economic engine that literally his entire purpose is to sell. So my job then is to incubate a product and brand in that market to determine the salability and upside potential of that brand, and to determine which products fit into that brand and most align with the intent of that brand's outcome to service people who want to see a change or something different from their product, and get it in their engine and then let it do the best possible way of putting that product in front of people as quickly as possible to solve that big question. How do I get eyeballs on my offer? And the other question is, what the heck do I sell? And this helps answer that question in the numbers, literally.
It's interesting because I feel like this is a bit counterintuitive to what most people would say out there. I mean, the playbook for
Yep.
maybe the last 5 or 6 years has been, if I have an idea, run Facebook ads, right? Get people on a wait list, figure out if they want to be there. And I don't know if I'm hearing it correctly. Are you saying that you should have the product and launch on Amazon immediately? And I've kind of heard this narrative that you can't really build a brand on Amazon. It's good if you've got a brand elsewhere, but you
Yeah.
can come on there and get it there. But how do you launch
Yeah.
something brand new that's net new to Amazon to, if you only have 30 seconds to convince them, or in reality, like you're saying, you have to convince a
Yeah.
machine to serve it to someone who may make a decision in 30 seconds?
Well, you actually can build a brand on Amazon, but you have to understand it is just a single sales channel. So to build a holistic e-commerce company, you will need multiple sales channels. It's just when you need them. And I think a lot of people get caught up in the idea that, of course, money loves speed, and that's an important part of any entrepreneurial journey. But business owners also know that brand value trumps product value. So at the end of the day, my brand is ultimately going to win because I'm going to see it rise up against other competitive brands inside of that ecosystem that I'm targeting that actually drive the customer based on brand. Now, they may have come to Amazon, but everyone is brand driven. So Amazon may be one level of brand authority, but the actual product is where the brand authority truly lives. That's why you might choose a Ninja over a Breville or whatever inside of the ecosystem, because ultimately you look at it and go, yeah, that's a brand I recognize, that's a brand I can trust, even though you started on the Amazon's platform because you trusted it with your credit card information and it delivers the product to your house almost all the time without fail. And if there's an incident, they will deal with it. You know how to return it. You know what your rights are as a consumer. So yes, you can absolutely, let's debunk that myth. You can build a brand, and here's how it would work. I just launched a brand on Amazon 30 days ago, a new brand, and we took it to 65,000 sales in 30 days. It took such a rise so fast inside of Cosmo's engine that it prompted their growth team to reach out to us and say, hey, we want to partner with you for a year for free. We want to run this out. How much inventory you have? Here's all the stuff we want to do with your brand. We want to blow it up inside, because they recognize that my brand is taking over market share in our space. Blizzy is the brand. Blizzy, Blizzee. And Blizzy is play on Blizzard. It's an ice cream maker. It's an ice cream machine. But here's the thing. When I saw Ninja in the marketplace and I saw a data segment in my tool that we created called Cayman Data, and it's an intelligent AI agentic tool that goes out and finds data and processes it through my algorithms to pull out the highest profit, highest demand, highest upside potential products. And I look at those products and say, can I build a brand in competition with somebody that's in the market already and meet them at their price point, meet them at their value, meet them at their current data set? And can I beat their data set? Because I'm brokering information to an AI engine, right? So I'm looking, can I beat their data set in the brand performance? And so we targeted a product that had a ice cream machine in the market that's selling more than 2,500 units a month. And we're like, hey, I think we can do that. It's a $389 product. So we went and we looked at the way to innovate that product a little bit. And ours basically has a no pre-freezing. With the Ninja Creami, the major difference there is they got 24 hours of freezing. Well, with my product, it takes 30 minutes to make ice cream. So it's a very big difference. There's no pre-freezing. You mix up your favorite dairy, coconut, or whatever. You pour it in the back of the machine. 30 minutes later, you pull the handle, and out comes your favorite soft serve, your protein ice cream, your coconut, your dairy, your mix, or whatever you want. And it is taking off like a rocket. Not only is it a competitor, but if I can analogize this a little differently, there was a Coke in the market, but no Pepsi.
Mhm.
There was a Reebok and not a Nike. And you know how they park each other right next to each other constantly? Like you'll go across the street and there's a Walgreens and a CVS. You go across, there's a Walmart and a Target. Well, we just basically did the same thing. We borrowed from retail. We parked a product right up alongside of Ninja Creami, and we said, hey, oh, by the way, we don't pre-freeze. And everybody's like, ooh, you don't pre-freeze. So they started to buy the crap out of it. We're running out of inventory faster than we're going to make it to Black Friday at the speed at which we're accelerating the brand. Amazon recognized that and picked it up. And that's just one of a many product line where we have taken a opportunity market segment. We have looked at the profitability of it and the demand. We have identified in the data that we can sell data to an AI engine that wants to compete in the market with people, 36 million searches a year for ice cream on Amazon, and wants to put my product up there and say, hey, what about this competitor? And as long as our product is good, meets expectations, of course it doesn't break and fail and have problems and crash and burn on the outside, right? From bad reviews, which it's not, then we have a brand building exercise now that is going to lead us into what is projected to be it's $1 million brand and run rate right now. And the top end after the next year is at least 5 million within 24 months.
Not bad.
Not bad.
That's right. I think like what you've done is so smart, because a lot of times when I talk to founders, they say, well, my brand is my community. It's how I make people feel. And, all
Sure.
these things, like they'll lean into maybe the fuzzier parts of marketing. But what you've done is you said, look, I'm finding people, you're almost competing on features and need, right? And you're establishing that
Benefit.
brand by going to where people are already searching versus trying to create a new market. I feel like so many times you hear
Demand, demand creation is what you're talking about on one side, and then there's demand capture on the another side. And what happened was about 10 years ago when we ended up launching our first brand, we started doing a little bit of retail arbitrage, figure out the system, figure out how it went. Very quickly realized we need to start a brand. So long story short, I'm up one night feeding my third daughter. I have 4. And mom's super tired, and I'm always a late night owl, so I took the late night shift. And I'm up feeding this kid at 4 in the morning. Up pops this infomercial for a product on television. And it is a seat buddy thing, and it's got like you put the animal caricature looking doll, and you can rest your head on it. It's super cute, and they got a cat and a dog and all this stuff. And I'm like, man, I need to get one of those for my kids, because that was the first thing I thought of. And I'm like, no, wait, I'm a producer. I got to think about this from like a business perspective, not like a buyer. And all of a sudden it dawned on me, I was like, I bet we could sell one of those. And we went to Amazon. It's like they have a listing. It's terrible. They're not really selling very much, but they got to be spending $250,000, $500,000 on infomercials. Wow. They got to be selling that product. And at first, it started what we call our As Seen on TV strategy, where we were simply looking for products that had demand capture available that was not being captured on Amazon. So we launched our own brand, and we sold out of 2,000 units in 8 weeks organically. Wow. And at that moment, we were hooked. And we got to 7 figures in 2015 on that brand. And it started by just recognizing there's a tremendous amount of demand. We don't need to create the demand. We don't need to be Elon and come up with some unique invention, because I did that all the way into bankruptcy, so I don't recommend that. So I recommend innovation over invention to get in front of demand. Instead of telling the market what I think it wants, I simply look at the market, look at the data, have an 80% confidence that I know the market wants this product, an ice cream maker, 36 million searches, one top competitor, no one is meeting them on features and benefits, differences in the benefits at that price point. I'm going to go see if I can create a brand around it. And guess what? We were right.
Yeah. I'm sure there's been other examples that you've tried and it hasn't worked out, or maybe you're batting 1,000.
Oh, yeah.
Talk to me about what you learned through the things that the hypothesis didn't work out the way you expected.
Well, no product has a infinite life cycle. Brands live forever. So people have to debunk the myth that a product idea that I launch will always have an ultimate success. What it will have is an opportunity for innovation in the marketplace to adapt to any sort of changes in the market, interest, tariffs, changes in people's buying behaviors, changes in their taste and interests, for any kind of thing that you have with any product type, from bed sheets to ice cream makers. Really, it gets down to if you're willing to adapt to the market and change the products and innovate the products to match the market conditional changes, then ultimately what you're going to get is a brand-driven consumer value, regardless of what kind of product actually powers that, because products have a life cycle, but brands can live forever. Even brands that you and I would never purchase, or maybe can't purchase or don't want to purchase, we know about them, even though we've never purchased. And we may not be able to ever name off all the different types of Ferrari, but we know they exist, and the value of their brand is there because the products extol that. So when people get caught up in the products, that's where my don't marry your product kicks in. You do not marry your product until it serves you. And if it's not, that's what's called the sunk cost fallacy. If I'm putting an interest into a product that is no longer serving the business, that product has to go in lieu of another product. So when we developed our 5x5 methodology, it is to launch 5 products into the market with features and benefits that relate to the brand itself, by not going into very disjointed segments, but staying within that brand narrative and determining, as law of averages go, which one or two of those products really takes off. And as one or two of those products takes off, it's already been predefined in my green light process that it'll have anywhere between 25 to 50, upwards of 100 variations of that product that can go in the market when that hero product identifies itself in the data. It's all a numbers game. When that product goes out, should one of the other products simply not make it, either through bad alignment when we prompt the engine when it first goes to market to determine what it is, or we simply can't optimize it through pulling certain levers to get it to dial in to the expectation, we let it sell out of its inventory and it goes bye-bye, right? A product can fail. Brands only fail when the owner gives up.
Yeah. As you're saying that, this immortality of brands, it reminds me of Shinola. I think it's like 100-year-old brand. And it was first known, I think, for like hair gel or something like that. The brand went defunct.
The Dapper Man and all of that stuff,
now it's
right?
a premium watch brand.
Well, go read Good to Great. It's sitting on my shelf here. You'll find brands in there that existed and don't exist. You'll find brands that turned from good to great that are now bankrupt. Right? So what ends up happening is people get caught in the idea that because they like products, the product is the brand. And that's the myth we're debunking here. It is the brand-driven power difference between you buying an iPhone because of your personal choice of preference, even though there may be some features or benefits of an Android you like differently, but you prefer either the look, the priority, the functionality, or certain features of the iPhone, so you stay with it, but somebody else will absolutely love a Google and Android phone and tell you that all iPhone people are fanboys, right? Who are completely distorted, and they make jokes about how we had that feature 10 years ago, right? So, it could be that with a Honda or a Toyota or a Lexus or an Acura or a Ferrari or whatever. It's going to be something that is personally brand driven. And what I am after is, where is that brand driven affinity in this platform I'm incubating this product on? How far can I attach this brand's worth in literally like a NASCAR stream? Okay. So we got out front Ninja, and I'm just whipping in between cars right now with the Blizzy, trying to move myself into second position, right? Second position just starts tapping them on the bumper. And hopefully at some point we'll get acquired, or Ninja will just be like, knock it off. And they'll want to acquire us because we've now taken some brand market share and basically slipstreamed in behind them. I can make millions of dollars in that brand just slipstreaming in behind a major product, becoming the Pepsi to their Coke. So it's brand-driven relationship I'm after. The products will eventually, and are going to adapt. We're going to have different variations. We're going to have different sizes. We may come with a color pattern. We got a whole bunch of ideas now. We did 65 grand in that product in the first month, dude. We're racing through that product. And that is only the beginning. When you target certain metrics and platforms, you've seen it like virility on the information side, right? When people get a certain component of virility in the information side, you can see them hitting millions of views on their videos. Well, the same thing happens in an organic engine like Amazon with physical products. People just don't see it that way. When that engine turns up that traffic and it's like, hey, you're getting bigger and bigger market share, it is pushing me in front of millions and millions of more people. And as my data has now been programmed correctly, here's a pro tip. There's a little score inside Amazon called an IDQ score, and it is given at 100 points when that listing goes live on Amazon. It's yours to lose, okay? You lose it because you didn't properly prompt engineer the correct listing data in the structured file format you give to Amazon that gets Cosmo to say, I know who you are. I get it. Think about it like a bad video you have to redo the prompt on, or an image you created and you're like, well, that's crap. I can't use that. For anybody who's done any prompt engineering in the AR world, we're basically prompting Cosmo. And as long as we make sure that we have tools to test and validate that my data is structured correctly to Cosmo's expectations before I upload it, my IDQ score stays higher. And it's mine to lose through negative reviews or other metrics in the system that make it more derogatory. There's a health performance kind of thing. And if we get too many returns, if we have any problems with the product issues, or returns have reached a certain point, that will start to lower our IDQ score. If we keep it really high, it's just a matter of time and capitalization of inventory in order for us to become a Ninja Creami in the marketplace. And as it stands right now, we were number 31 in all of ice cream makers. And the other products above us are Ninjas and a few others. And we are going to outpace them once we up our inventory because no one else has the benefit of no pre-freezing in the top 30 above us. So we have the feature, benefit, and demand. Now it's our opportunity to lose if we don't capitalize it.
It sounds like you've really gotten this playbook down for what I would call the pre-agentic AI world, right? And you mentioned at the beginning that we're kind of going direct to machine, and that's the future. And we,
Yes, we are.
we hear these announcements with OpenAI partnering with Shopify and Walmart and
Yeah, yeah.
everything else.
Hmm.
How big of a shift do you think that's going to be? Because on one hand, it almost sounds like Amazon has kind of already been doing that, and so you kind of know what to
For about
expect.
3 years.
Other people may be like, "Hey, this is completely different." So, how should we be thinking about this direct-to-machine model?
Yeah, it's a great question. If you are looking at it from the old world of search engine optimization, which is kind of put a website, optimize to keyword, do all these signal things, get backlinks, all that old world stuff, that's gone. It's absolutely gone. What is in now is structured formatted data that you can submit to the OpenAI platform, Perplexity, and others. Or if you open a Shopify store and you configure it correctly, it will automatically submit that data through their relationship now, including Etsy and Target, into the back end of those GPTs. What they're anticipating is if you've done a good job of pre-structuring your data through queries and customer intent language, that it will properly read and turn your Shopify listing into a response when somebody asks, well, what's the best ice cream maker that doesn't require pre-freezing? And it'll say, oh, well, Ninja Creamy requires that, but the Bleezy does not. You might want this one. And they'll go, that's the one I want. Order it for me. And the agentic shopping agent will go order it and then respond and say it'll be at your house in 2 days. See, this whole world is completely different than the old world of SEO. You're telling the machine to do the work for you after it's already done the work to help you choose which product based on all the information, data it's gathered, and information about you and your personal preferences. It becomes a personal shopping agent. This is a very new world. SEO of the old world was you forcibly looking and going and then selecting and purchasing. The SEO is being done for you by these GPT engines. Amazon was already ahead of that when they launched their Cosmo engine 3 years ago because they need to keep forward with their models of continuing to adapt speed and agility through purchasing to kind of be competitive. Surprise, right? So as these other engines are keeping up, since Shopify is just a platform, their best maneuver is to partner with a GPT engine. And that's what they've done. And so is Etsy, right? The other platforms that don't have the same strength of organic and marketing that Amazon has, they've had to go partner outside. Amazon doesn't necessarily need that, and I don't even know if they will, because what's happening with Amazon is as its data goes and structures forward in Amazon, the other engines are picking up that data. And pretty soon, they're going to end up picking up Amazon listings because they're going to have to, right? They can't just isolate that and cut it out. And when our data is right with Amazon, we know it'll be sent over to these other engines. For now, we're going to go ahead and submit that data into the engines and make sure that we get it right because we know what it should look like. But this is the new engine.
When you as you kind of think about how quickly things are changing, and it feels like we're all kind of figuring this out, both the LLMs and the consumers and the businesses. If I am either a buyer of business or a seller of business right now, how do I value this? Because what you're saying is that somebody that had a great SEO track record or had great organic
Yes.
traffic, that may not matter anymore.
No, it doesn't. No, it actually doesn't. And I'm not looking for businesses that have that. I'm looking for businesses that have structured platform and brand identity over a period of time, at least 5 years or more, who have at least $1 million to $2 million in SDE in their business and don't rely on SEO as the primary method for gaining it, right? Because the next step to optimize that business is we take them into multiple platforms, and the first things we're doing is optimizing and structuring their data for the GPTs. And if it's Amazon, we're restructuring listings and components and updates to optimize them for Cosmo. Amazon first, because of the way their economic engine moves, are going to be grandfathered and start losing momentum here soon. Okay, they're going to start losing market share because they're simply not optimized for what Cosmo is looking for. And as my listing becomes more relevant to Cosmo for the amount of people searching for ice cream makers, if the people above me do not get ahead of that optimization, I will just overtake them. And by the time I've overtaken them because the Cosmo engine is doing it for me, then they will have to go and optimize and pull levers to fix their listings that may have been there for 2 or 3 years and are outdated.
Yeah.
They simply don't align with what Cosmo is looking for. In the world of SEO, they'd be deranked, right? They'd move back 2, 3, 4, 5 pages, and that's where they're going to miss their track. The Marketplace Pulse basically predicted by end of 2026, Amazon's primary profitable channel will no longer be AWS hosting. It will be advertising.
Wow, that is a shift.
Yeah. It's a huge shift, which is why brand management is changing internally, why anybody who launches a great product and does the great job with the Cosmo marketing engine inside of it can be picked up by Amazon now because they're identifying that engine has a component. I just learned this last week. This is cutting edge. I didn't even know they were doing this. If you hit certain metrics in that platform, they will assign you a team.
Okay.
Anybody, because they are going after brand management. And with that, they know those who are in line with what's happening in the change are the ones that are going to win the day, and they want to support that because they love a good story. They want a brand originated US marketplace seller. They love all that stuff. And there's a huge opportunity, probably better than I've seen since 2013. The complexities are different. The opportunity cost is different. And you can't sell a sub $50 product on Amazon unless you plan on revenue volumes and then making it up with multiple or virtual packages to increase the profitability of additional products in the market, because you simply can't make a sub $20 product very profitable anymore, like $1 to $2, maybe $3 in net profit per unit. And people are like, well, I'll make up for that on volume. And I'll say, well, you have no idea about business. You need to go back and learn business, right? 2,000 units move this month at $1 in profit, and you move 4,000 at $1 in profit next month, you're screwed. Right? You have to go through the net profit. So everything we focus on is net profit, which is why we do $50 to $500 in retail price point. We have net profit minimums. We don't target products that don't have a high net profit or ROI turnover. And we go, for those of you who understand cash on cash value, we need a 4 inventory turn every year to optimize that brand for 2-3 years worth of growth opportunity in this system that will become like a snowball, so that scale is possible in year 3 through 5. What does scale look like? The older system, in 2015, we launched a brand with one of our clients, and we helped him get to $5 million a month in 8 months. The newer system is a little bit different because its attribution models are 12 months now, not 90 days. So when people get in this business, they need to know this is a 12, 24, 36-month ramp to success. It is no longer a sub 12-month ramp. So anybody in the course and program world is screwing you over. I just got to say that out loud, right? If you don't run this business like a real business through months 12, 24, and 36, you will not succeed. You need the capitalization to do that because you need the profit in the business, and you need the inventory turnover of 4 times in a year. And if you can do those things, that is your opportunity. Okay. When your ROI is 50% and you turn it off 4 times a year, how much are you making, Aaron? You're getting a 200% ROI on that product. You now have a product that can pay for itself, add marketing, and send profit to you. And you have the engine and upside potential of large growth. And I want to let people know this, okay? But in Amazon's first year, they have kind of a cap of opportunity, about 5% of market share they see on average a brand growth in year 1 can achieve. But once you reach certain like 10, 50, 75, and 100,000 a month in revenues, if you continue to maintain that into year 2, you can see up to 20% of that market share. And by year 3, 40%. Mm-hmm. Okay? So years 2 and 3 are the building and then growth years, and scale can happen between 3 and 5. You do it right, and you could be one of my students like Daniel, who is getting an offer right now for around $25 million. He's got his intent he's going to sell in 5 years. Because this economic engine is so huge, most people limit their expectation based on YouTube videos and hopium guru mindsets. And we're over here going, in 5 years, $5 million is a minimum in revenues, with at least 20% in net profit at the bottom line.
That's so interesting.
So totally different world.
So when you're looking at buying these businesses or whole, I mean, it sounds like you're taking this 3-year approach. Part of what I imagine you have to do now on the sell side is educate the buyer in terms of how quickly things are changing. You talked about how when you're looking at these deals, you're trying to understand how optimized they are for the GPTs out there and restructuring things. How do you actually go out and do that? What's the extent where your seller may just see the growth and be like, this is great, but they may not understand why you have like a real asset in that data advantage that you built. So how do you make that bridge happen?
Well, in the buyer capacity for an e-com business that is private label, we're inventory driven. So the asset of the business is not only the value of the brand, but the inventory we have in that business. So it's not a pure digital play. It's a physical, real estate of the digital world and an inventory-based opportunity on the back end. So we take cash, we put it into inventory that's worth 5 to 10 times what we bought it for. So there's a very different asset-driven class to e-com companies than, say, just pure digital or consulting companies or, course companies and that kind of stuff. With that value, of course, inventory turns brand and brand turns to customer, and that builds that entire ecosystem. That is building, a business in the way we have created them. And the economies of scale don't require you to have a whole lot of warehouse and upside. For example, we just went through an acquisition with a partner company called Patriot Growth Capital. It was a $7.2 million purchase, a $14 million a year business. They have one guy in a 10,000 square foot warehouse and one operator, and like 5 virtual assistants at different areas of operations to help manage really what is the retail side, because most of the online stuff is automated. These are the kind of businesses we're dealing with now. I don't think people understand the world we're living in now is a senior person with 5 sub people, or a senior person with a couple of AI agents that are running certain components of optimizations in the business. This is the new world we live in. That warehouse is only there for mostly just flex space and retail. Otherwise, most of our companies at scale have no warehouses. Amazon is our warehouse. We use and use that infrastructure to move and ship customer, last mile, and then set that up for multiple channels. So if somebody orders on Shopify, Amazon fulfills. If they order on TikTok, Amazon fulfills. If it's doing really well, we stick it in Fulfilled by TikTok and let them fulfill it. So those infrastructures are all there to leverage virtual-based opportunities where my economies of scale to a 6, 7, 8-figure business is nothing like it used to be. People think you got to hire like 10 people. No, they think you need to go out and get like 10,000 square foot of warehouse because you have all that No, that's not actually how it works anymore. So I think a lot of people are falling into that old school trap when the new business model is going to be the first billion-dollar company ran by like one guy and a bunch of virtual agents.
Yeah.
It is such a different way of people addressing it. So at the equation of the exit, we build everything to go to exit. Now, where can it exit? Well, I got private equity groups. Guess who owns the business? So as we go through the exit stage, we sell to our private equity groups where we're the operator. We may even buy it ourselves. If we feel like it's a really great business that's achieved good stuff, we'll step in and acquire it and become the operator because we saw it from the beginning. So people who work in my client base have an exit potential. All of them. That's the whole point. That's what we call the platinum principle. That is the component by which every business is built to an exit because it's worth more in the end than at any time during the business building phase. And while it can do cash flow and toss off great profits in 3 to 5 years, it can create generational wealth exits. And that's what people really need to be thinking about when they build a business.
So talk to me about kind of how you guys apply that platinum principle. What is it that actually qualifies it to make that generational exit?
Yeah, it's the multiples of the profit. All right, there's 2 different ways to look at it. There's seller discretionary earnings, known as SDE. There's EBITDA, okay, earnings before income taxes and depreciation and amortization. Those are 2 different metrics to look at differently. We prefer to look at SDE, which means that buyer equity in the business or cash flow, assets, and what they're paid can be pulled back to the bottom line. And at the bottom line of that number, let's say it's $1 million. If it's a single channel like just Amazon, it might be worth between 2.8 to 3.2, depending upon the profitability of that single channel. If there are additional channels, say Shopify or TikTok, and that adds on another 5 to 10% into the revenues, but has a large upside, as long as the last trailing 12 months has a strong and profitable baseline, that could add on another point to another 3 points to the basis of which we buy. If they have a retail channel that's doing 20 million, could be 2 million, could be 20% of the business on top, that could add on 3 to 5 points. So you're looking at a business that a single channel between 3 points could end up in an omni-channel sale between 5 to 10x what the profit is. So as the owner looks at creating these individual channels, they're building an asset-based class that continues to evolve, not only through the cash flow, operations, and inventory, but the saleable state of that business when it comes time to exit. Because they'll be able to ask for greater multiples, 7 to 15x on a multiple versus 3 to 7x is a very big difference when it comes to closing that business out.
It almost sounds like you take a strategy of holding back and not getting into as many channels as someone could do. I mean, I see a lot of founders that will be like, oh, we launched, a year ago and we're trying to get into every retail and we're getting into Europe and we're doing all this
man.
stuff. It sounds like you're saying, like, hold it close, do what you can in the one channel and sell that dream of omnichannel.
Focus until successful with that first channel, because you can do 6, 7, 8 figures on Amazon in revenue. Most importantly, you just have to make sure that you do it profitably. Net profit being the biggest factor, not the revenue, of course. When the time comes to reach certain components, you're going to realize that market share is being gained at a pace fast enough that the business is now telling you, open another channel. So with the Blizzy, at the speed at which we're accommodating inside of Amazon with the support, protection, and brand protection we now have through their media channel, through the next launch of a slushie that we're putting in the market that they're going to help us launch here in about 3 weeks, that thing is ready to be moved to another channel only in the first 3 months. I would have not normally do that, but at the speed at which it's going, we need to get a Shopify channel on next, because at the Shopify channel level with AGP commerce, agentic commerce, and the new structured protocols that we're seeing with these GPTs, the speed at which that one is rising, I need to get that in those like fast. And so the next stop is to put that Shopify online, get it there and get it structured and submitted into the engines, and then let the ecosystem go. I don't even need to start meta ads yet or worry about the front end marketing. I need the engines to do that for me first and see where it's going, because then ads put gas on fire. And I need to know first, how well is the market receiving that organically? And that's why I would put that channel on in the next few months, get it structured, get that data out there, open that channel, because the opportunity is presenting itself. And very quickly after that, I would go to TikTok, because it is a demand creation platform. Okay, it's not a demand capture platform like Amazon. That's where the social strategy of creators and social network would then go and do a lot of videos about the differences between my product, Ninja, or others that are in the market, and then extol the benefits of that through creator content into the TikTok platform, right? To vibe up that create. I didn't know it existed. I didn't know it was there. Well, how would they not know that? It's on Amazon right now. It's not on the other channels. It's going to go into the GPTs. So there's a strategy by which timing now demands that I do that. Other brands are not at that speed, but they are growing. So they will stay longer on the Amazon channel until market share is gained faster over longer periods of time, because a couple of them are in really big markets. So it's going to take a little bit longer for us to crack into that market share and really see that opportunity. But there'll be a point in the numbers, there'll be a point in the cash flow, there'll be a point where we see it responding in the market share where we'll go, time to open that store, time to get on Shopify. You only need those two channels to build a $20 million a year business. I think, again, people don't understand that it is an omni-channel. You got to be careful when you're in the cash flow. I think it's irresponsible for a lot of people to be like, we want to open every channel. It's like, do you have millions of dollars to blow to go figure that out? Okay, that may be your thing. Most people don't want to go just blow millions, and retail's a big thing to bite off. It sounds really sexy, but it is extremely expensive to do the right way. It can be very rewarding, but it requires a lot of capital management, a lot of fiduciary responsibility to get that done right. And you own a lot of the problem if it doesn't work out. Right? If you sell $1.5 million to Michaels and they decide, well, we only wanted 750, guess who gets to eat the other half of that and figure out where to sell that product? So there are gotchas in this to be very careful with capitalization. I think focusing and intent with these kinds of engines does no longer require you to necessarily be on every channel right up front, especially in the first 12 months.
I mean, it kind of feels that your advice to a founder is to let the market pull you into a channel versus, push yourself into a channel, because that's where I'm going to get my growth. And so it's almost like, let the growth pull you in there. You shouldn't have to pitch a retailer for, why they want to take your product. They probably want to be reaching out to you like, hey guys, like, we'll make some space. Like,
we've had that happen. No, you're right. We've had a couple of retailers want to put us on their platforms first before their stores, but they found us on Amazon. So the buyer, who's a normal person out there using Amazon, like a whole lot of other people are, said, I love this product. And they looked us up and reached out and said, hey, we want to put you on our marketplace.
Yeah, that's great.
It's a good signal to the market that we're going the right way.
One of the things that I think is interesting is you're talking about the exits once you've reached single millions to $20 million in revenue or profit. What is the right exit window for you? Like, how do you think about those sorts of things? I feel like some people say, oh, you know what? If I'm going to exit, that means I got to raise $100 million in VC money, and I got to work for 10 years, and I got to sell for $1 billion. And like, those are exits, those are valid ways. But I imagine that most of the exit you're seeing don't fall into that.
No, we like to do it out of cash flow. If we're going to capitalize credit lines, it's got to be very smart. Market plus two can be very dangerous for a business who doesn't understand fiduciary turnover of inventory and capitalization. And they think, okay, maybe those founders are raising capital for a software company. Very different median by which raising capital. They might want to go out and consolidate a bunch of brands into a portfolio and raise hundreds of $millions or more. I've done that, and you can see how that can work and not work. But you want to look at a way by which capital deployment in certain businesses can be very smart or very dangerous, and always sounds really sexy when somebody's like, well, I got 15 million in seed funding. And then you find out 2 million is gone in the first 30 days. And 2 years later, the bank crashes and they never got the product off the ground. Again, what sounds sexy to others in business is typically for likes, viral, and comments. And what I'm looking for is what actually makes sense to run this business properly through cash flow. We'll use inventory financing when it makes sense. We only take down what's necessary for inventory, and out of fiduciary responsibility, that's what gets paid back. I think a lot of founders go, well, I'll get this much for inventory, I'll hold this much back from me, I'll pay myself something out of that. And again, it's self-control and experience in business that says do not do that. And I think a lot of people get caught up with these great ideas and these super awesome stories, and they're super great for those who get it done the right way. But what you have to understand is most businesses fail in the first year because they don't understand how to run a business first. And that's really the overarching thing I hope people got away from today and take out of this conversation. Everything I've been talking about is running a business, not even really running an e-commerce store. Some of the tactical things are relative to the channel. But what I need you to understand is there is a business to be ran. There's a profit and loss statement. There is a mode and mechanism by which we make money, similar to a real estate or some other type of business model. But it literally gets down into when you use capital, how you focus your success in what's working in your business to generate revenue, who you hire that is generating revenue only or don't hire that role, and how you manage a company to an exit successfully. That's a big ask, right? When people don't even know the fundamentals of business. So we have to make sure we stay focused on when we take capital, how we use that, when we focus change, and given some time, okay? Given enough time for different people, everyone has an opportunity to be successful. They will just typically give up before the success comes. And that's where the focus comes on. If you can get the one channel running really good and you're on your way past 7 figures, you just learned a big lesson. Once you get past 7 figures in business, you've outpaced 80% of entrepreneurs who really say they do but don't, or they made it in revenues but not in profit. And that's a dangerous thing too, of course. But yeah, the requirement of a particular type of capitalization, the way you structure it, really at the end of the day, it isn't even at the startup process. It isn't even the methodology by deploying enough product to discover what wins. In our business model, it is the inability to capitalize, the risk to reward ratio that you simply can't get past, or your willingness to try to force something that you think needs to happen when in actuality you're just not listening to experience either from others or from what it's telling you, and you're not willing to do it. You want to do it your way. And that's when this thing will crash.
If you find that most of the would-be entrepreneurs or people who just can't quite crack the exit mentality either don't understand the fundamentals or they don't have the self-discipline to stick to those fundamentals.
Yeah, I would say it's kind of both. It's just win. First, if you can learn the fundamentals first of structuring a business, an LLC, taxation, formation, bookkeeping, and planning and accounting with an actual 90-day cash flow plan, you have an opportunity to get to the next level in business. The next level in business, by success with that metric, with patience and time, will lead you to a realization the business is going, and it is only going to keep going or reach its next level if I'm willing to put down any past hurts, pains, fears, etc. I have personally as an owner and take that next level of risk that the business is requiring me to do. I've never had $500,000 in capital credit line, Neil. I don't even know how to get it. I don't even know what to do with it. There's a problem, right? Because if your business needs $500,000 in capital to run to the next level, you got to do that. If you don't, it isn't that the business didn't work. It isn't that the brand isn't working. It may not even be that the products aren't right. It's you. So typically for that first 1 million, it is all learning how to deal and structure and become successful at that. From 1 million to 5 million, it is systems. It is repetitive understanding of how I got to the million and continuing to repeat that process until success is boring. Because I know that this is how it works and this is how it goes. From 5 to 10 million or above, do you know what the last thing is for anybody who wants to get to a $10 million a year business?
Tell me.
It's the owner. It's always the owner. It is never the market. It is never the upside potential. It is usually the owner's inability to have structured a system that doesn't have them in certain linchpins in the business that require them to be available all the time. They feel like they're the only one that can do it. So they're in a situation where they cannot grow. Their arms are as far out as they can get, and they simply can't go any farther. And it is usually always down to the owner of the business.
No, amen. I've seen that time and time again, and I'm sure as every founder who's listening says like, oh, yeah, that's been me at some point, or that is me right now, and I gotta change some things. You know, so much of what I've been thinking of as you've been going through this is it feels that there is this threshold of agentic commerce, this direct-to-machine mentality you've talked about. And I feel like so many of us are peeking through the window, you know, maybe dipping a toe in, but you've stepped into the other side and you're like, feels like you're living in the future to some extent. Can you just talk about your journey for how you learned, how you taught yourself? You know, I imagine because it wasn't something where you flipped a switch and one day that's where it was, but how do you go about
Yeah.
like learning and teaching yourself this direct machine mentality?
So in all fairness, I've been at this for 18 years, right? I've always been somebody who's played with tech since I was 16, and since it came online, and since we were in the CompuServe days and AOL dial-up, I've always played around it and in it and understood it. I just had an insatiable desire to keep learning and doing and executing and failing forward. And that kind of took me through life. And eventually, by the time I got to IBM and through the Sprint days where we were launching brand new technologies, mobile phones, and systems of control, knowledge management, machine learning, all this stuff was coming online to help control all that. By the time I get up to driving media and traffic for my own offers and business consulting, when I had the free time to do the marketing, that's when I got more involved in back into the marketing and the engines and the online. There wasn't even Facebook Marketplace. There wasn't Facebook ads. There wasn't Google ads. We were uploading, media buys and spreadsheets, right? Old school. And those systems were just coming online. And so I saw how fast they were moving. And I, get up to the idea of like, okay, I've got a product, I got a marketing, but I don't have a business. It was a really hard revelation. I need a tangible asset. I'm making a lot of people other money with my skill sets. I'm not keeping it all for myself. It's not my own business. I'm contracting. I'm doing lead generation for other companies. It's just not all mine. And so I'm like, well, how do I get to that? And then a friend of mine was like, well, sell physical products. And so it was like that duh moment, like, duh. I got the marketing on one end. I should fill products on the other. So I went on a journey to figure that out. And I ended up at Amazon. And I ended up in a course, which was expensive for me at that point. And I was like looking around going, I know business well enough to know that this isn't teaching me about the business. There's a lot of hot air being pontificated here. So I started a little mastermind in that course. I pulled 20 people together and said, hey, I'm having these kind of problems. Are you having these problems? Let's just go to another group and let's figure it out and see if we can do it together. Well, a guy jumped in there. His name was Reed Larson. And he and I hit it off real fast with his CEO experience as CFO. He's a very operated driven person. I'm the marketing guy. Jump off the bridge, see what happens. He's like, no, we don't have a backpack. I'm like, well, let's go anyways. So we really hit it off, and so we started to look at launching products together, and that's when we just started to figure out the system of business and how to make it work until we hit that first 7 figures in 2015. But here's the thing I learned about this: that was all a knowledge management platform back then. Amazon's engine they created was a knowledge management platform of learning and machine language learning. So very quickly, as I started to discover how brands were different than arbitraging products on their platform, I started to realize that the economic engine inside was similar to the ones we were building at IBM. So it dawned on me, I should go test this out. I should go play this theory out and see if I can come to sort of conjecture. So I started to play around with the system and realized that Amazon's first iteration of their, learning engine was very similar. And so it needed certain prompts, it needed certain timings, it wanted to see certain things occur. There's like an internal ecosystem of rating and control similar to the ones we built before to allow language and information to turn over faster so people could get their answers faster. Well, in this case, it was so they could get their products faster. And I was like, dang, I understand that engine. So I laid out like a launch process that kind of targeted over 30, 60 days the different things the engine wanted to see and how to structure the way we talked to the engine. We started defining it as priming the engine to get it to respond positively so that we could get higher and higher rankings faster and faster. Well, it turns out it did really, really well. And with that learning, when the forward compression of that all kept going into the AI space, I knew we were headed to these major updates. And then by the time Cosmo was announced, I'm like, yeah, that makes complete sense. They now have enough data from all of the years and years and years of information to feed it into these large language models that they now can get that thing to start kind of almost AGI itself through learning and information on the AI side, which is much faster and much more accurate and much more efficient than the old school engines. And then we watched and played with Cosmo. I looked through their white papers. I went on their research. I dug into all that information, and I saw where they were changing Cosmo. So we updated our Greenlight process and our launch process to adapt to what Cosmo needed. And we started that 3 years ago.
It's been pretty good so far.
So far, so good. Hitting a lot of home runs with products which the engine loves. Products that are already in demand. It's not rocket science. I've taught a lot of people to do it, over 300 people to do it since 2019 in a one-on-one way, and make sure that they understand that the new world of e-commerce is how you structure data for AI engines whose entire job now is to put people in front of product and information as quickly as possible to get them to disseminate it or purchase from it. That's my customer now. Their customer is you, the guy who may order it on Amazon or Shopify or TikTok and get that. And once you get that delineation in place, you change your entire thinking about the complexities and difficulties of an e-commerce company, and you should switch into a fiduciary managing a very strong prompting process of creating listings and information for these things, and of course creating a great product that won't break so the whole engine doesn't collapse on itself. And that is the opportunity. I know I oversimplify it when I say it that way, but that is the opportunity.
Now, Neil, this has been phenomenal. I've learned a lot. We've got one question we always ask our guests on Build a Business Worth Buying to wrap up.
Okay.
And I'd love to know from your perspective, of all the products that you've seen, all the business you've worked in or been around, what's the best example of a moat you've seen someone build?
My friend, Matt Harward, he was a consummate business professional, smart guy, had already had a 9-figure business when he came to start the Amazon world. Kind of being so smart, he fell over himself on the things that he needed to do and overcomplicated things that were actually simpler than he realized. When I showed him how to take advantage of that and coached and trained him in the right way and processes to make that work, it kind of clicked in his brain, and he ended up taking over a couple of categories on Amazon very, very fast. He's the one that got to 5 million a month in 9 months. So when that economic engine kicked up, what he was good at was building teams. He was good at building silos of people and product into business. He had previously done it on a mobile app before mobile apps were good, and that was making a lot of money every month. He was very good at that, so he knew the business of business. He just didn't understand the economics of the e-commerce side. And when we showed him that, and we showed him how the engines were working, we showed him how to go, he took that business that had a $40 million run rate on Amazon and added on another 120, 130 million in direct-to-consumer sales on Shopify, and ended up being one of the fastest growing businesses in Arizona. He ended up clearing it out in 2022. I think he made somewhere north of 70 million for himself. He created a moat of that product and omni-channel through 2 channels that was doing 200 million a year in sales, and that was a very impressive watch. I give him kudos for actually executing and doing the things he was consulted to do, because a lot of people won't, but he didn't resist and he followed it. We set some big, hairy, audacious goals together. He's like, I need to make 400,000 a month in the next 6 months. And he's like, we ended up doing it in 4 months because he was willing to put the time, energy, attention, and money into it. He was able to see the reward others would dream about, but he also knew what it was required to do of him to actually make that succeed. So he worked in that team structure correctly and was able to see it and build himself a pretty good business out of it.
Phenomenal. Well, all of our listeners, thank you so much for joining. Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.